What's up, everybody? It is Tuesday, March 1st. Here we go. Biden making a State of the Union address tonight. I'm not going to be watching or listening to that. Folks, the market was down today. I'm going to talk about the impact of oil, potential impact of oil, or actual impact of oil prices going up on the economy. I said yesterday, can these sanctions and the consequences result in a global recession or a recession here in the United States and Europe? There's going to be some blowback. And I said yesterday I thought there was going to be a slow burn, oil prices going up, and that turned into a very fast burn today. We got up to 106 on WTI. I think we're up around 108 or 109 on Brent. Pulled back a little bit, but man, it just really started to go. Reports out. I saw reports from actual oil traders, physical traders, saying that Ural crude, that's the Russian crude, was offered at an 18, almost a $19 discount to Brent, and there were no takers. So it's not a question of the price. Ships are not going in there to pick it up for fear of being sanctioned or interfering with the sanctions. You can't get bank financing for that. So, it's a mess. And that crude coming off of the market, coming out of the market, again, I said yesterday, Russia supplies 10% of the global supply of crude oil. No movement on the part of OPEC. Right here, we're producing at 11.6 million barrels a day in the United States. That is down from the pre-pandemic high of 13.2 million. I believe maybe it was 13.2 or 13.4 million barrels a day. So we're well below what we were producing before the pandemic. So we got a problem. Now let me talk about the economics, because here's why it could have an effect. We net import about 4 million barrels a day of crude. Net import means imports minus exports. We actually import about 6.3 million barrels a day of crude, but then we export 2.6 or something like that, 2.7 million. That's something that could, by the way, it's just on a side note, if we need oil, why are we exporting 2.7 million barrels a day? That could be something easily stopped by Biden. He could just say, we're stopping for now. There's a ban on crude oil exports. It's still going on. It's kind of ridiculous with prices going up every single day, and now with the sanctions and the prospect of who knows. Right now, we're looking at a global demand of about 100 million barrels a day. And I think we're right about there, like supply and demand is in balance. But when you take that crude supply out, we're in deficit, which means that the price is going to go up until you get a demand shock, which basically means a recession. That's how prices are going to come down. But let me, again, talk about the economics. Let me try to break it down for you. So we net import 4 million barrels a day. It's like 4.1 million. Let's just round it off to 4 million barrels a day. All right, that's 120 million barrels a month. If you use $100 a barrel, that's 12 billion a month. Times 12 months is 144 billion. 144 billion with, if you look at the our GDP of like 22 trillion, that's like 0.7%. So remember, sometimes I say, well, the money doesn't fly out into outer space. With imports, the money gets transferred to the foreign sector. So that's income that is not an income flow to the United States domestically. Remember when I talk about inflation, that's just like a redistribution of income here. But when you're talking about imports, then it's also a net transfer to the foreign sector. So we are losing that income. That's going out to the foreign sector. And that equates to a loss of about 0.7% in GDP, if my calculations are correct. And that's at $100. If we go to 150, right, it's going to be 50% higher than that. You know, so it's going to be like 1.2% subtraction from GDP. Now, the Atlanta Fed is now calculating Q1 GDP growth at 0. No growth in the first quarter. I don't know if maybe they are already factoring in oil prices, but you know, we're right there on the precipice of a contraction. And a contraction is not going to be good for the stock market. Now again, my number is if we stay at $100 a barrel and given our, you know, imports, we're looking at a subtraction of 0.7% from GDP. So, you know, I think that puts us right about zero growth, if not slightly in the negative. And I'll say this, if we go above 100, like significantly above 100, then, I mean, a recession is in the cards. And a recession is not going to be good for the stock market. I mean, it's just not going to be good for the stock market. Now we have a situation where we're facing in 2 weeks the Fed is going to raise interest rates. But a curious development now, if you look at Fed fund futures and what they are pricing in terms of the probabilities of the rate hike, I've seen something very interesting happen just in the last day, the last 24 hours, that there is now a 7% probability of no rate hike in March. Now you might say, Mike, 7%, you know, there's still like a 93% of a 25 basis point rate hike. So you might say, well, Mike, 7%. But listen, just like 10 days ago, maybe less, maybe like a week ago, there was a 94% probability of a 50 basis point rate hike at the March reading. Now that's gone. That 50 basis point hike, I mean, that disappeared. Now we're basically, you know, you got a 93% probability for a 25 basis point hike, and you got a 7%. So there's been a shift. And we have seen bond yields come down. The 10-year is at 1.7%. By the way, I should add that the bond market is really, really short. Speculators are really, really short the bond market. The 10-year Treasury future has, the small speculators are short a notional, that's a face value of 25 billion 10-year notes. Short. Net short. In the last 5 weeks, the entire banking system here in the U.S. bought a total of 20 billion of treasuries, and I'm not even breaking it down into the 10-year. That was a mix of duration. So, I mean, small speculators are net short more than the entire banking system bought in terms of treasuries in the last 5 weeks. So the market's really short. And, you know, you could have one heck of a rally, like everybody, think about it, how everybody was so pumped up about how the Fed was going to, you know, they're going to do a 50 basis point hike and we're going to see 6 or 7 rate hikes this year. I mean, treasuries could have like an enormous rally, especially if we go into recession. I mean, the whole rate hike outlook is going to just collapse. And you know, this Fed, the Powell Fed, I mean, and I've spoken about these guys, the Powell Fed, many times. They just follow what the market says. These are not like Yellen, even Janet Yellen. I mean, she was much more of a leader, I have to say. She wore pants. Powell's just like, he's like a little puppy dog who follows whatever the market dictates. And whatever the chatter is, you know, that's what he does. And if we start to see an unraveling in the rate hike scenario, then Treasury's going to have a huge rally. But don't think that's bullish, because it would be happening under the circumstances of a contracting economy. That's not good. Contracting economy makes it very hard for companies to sustain profits, grow their profits. Really, there's only one way in a contracting economy that companies can grow their profits, and that's by cutting costs. And that, what does that mean? That means laying people off. And that could only go on for so long until your profits, start to decline anyway, because you lay people off. They don't have money to spend. They lose their income, and there go your sales. There goes your profits. So keep that number in mind, folks. We're at $100 a barrel. And, what does that mean? For every $10, you're taking off, 14 billion, which is like 0.007, right? For every $10 it goes up. So a couple of those, 4 or 5 of those, you're taking 0.5%, maybe more, and now you're over 1%, maybe 1.5% of GDP shaved off when they're already saying there's going to be no growth. So you're in a negative growth situation. So like I said, oil is going to be the key factor here. There's other things going on too. I mean, today, wheat, Chicago wheat was up the limit. The March contracted Chicago wheat, which is the prompt month, that was up more than 50-cent limit. That was up like 74 cents. Again, Russia is the world's largest exporter of wheat. I'm going back to what I said yesterday, that these sanctions were not thought through. If they were, it was in a very brief comment by Biden when he said Americans are going to have to, take some pain. We're going to have to take some pain to, I guess, to help Ukraine out. And that's what's going to happen. I mean, you're going to see gasoline prices shoot way up. You're going to see food prices shoot way up. So yeah, I mean, this is everything was normalizing. By the way, we had a really good February. It came in at 608 billion. That's really good. It came in at a 244 billion deficit for the month. But right now, the problem is right now, those numbers, those flow numbers, without the war and without the sanctions, I mean, and I was saying this, you're still only talking about maybe, 2.5% GDP growth. So you start subtracting off these other things, and there's a problem. I mean, your growth goes down to zero, your growth goes negative, and that's when there's a problem, and that's where we're headed. So again, I said oil was the key. Keep your eye on that. Today we had a big move up. Today, in the just after the market closed, in the API weekly inventory, we had a 6 million barrel drawdown in crude. That was a huge drawdown. It wasn't expected. Another drawdown in gasoline. So supplies are tightening up, and as long as these sanctions are on, and they're not going to take them off. Sanctions are sticky. Once they're on, they're on. It takes years and years and years and lots of things to happen, and treaties and a shift in relations and possibly regimes. I mean, they stay on. And this is just the beginning. I mean, Russia's probably trying to figure out a workaround to a lot of these things, but it's going to get increasingly hard, to the point where they're going to be shut down. And that, that's not just bad for them. That's bad for the whole world, because we need energy. Without energy, economies don't run. Anyway, that's it for today, folks. Keep your eye on that oil. Talk to you tomorrow. Bye.